I always like to talk about a few things that move the markets, and we all know that we're on the wrong side, I believe, of a policy error. The Federal Reserve, in all of their infinite wisdom, believed it was a good idea to hike interest rates into a global growth slowdown. We have had commodities in absolute free fall, although lately they've been stabilizing some, which is a good sign. When you have oil crashing and copper crashing, yeah, I agree. I will stipulate that some of this was because of new supply that came on as well as Asian growth slowing. But, just to say that it's a supply issue, I think is a little bit too simplistic. Although in the case of oil, I do believe a very large percentage of the drop is because of new methods of hydraulic fracturing and horizontal drilling, and a market share grab by the Saudis, but that's a whole other story. The fact remains, though, what is happening is the price has been coming down. It seems to be in a bit of a pocket of stabilization here, which is, I guess, good, because it had been in complete free fall. So I will say this, though, as long as oil is below this like 33.20 to 37 level, it is still a little bit vulnerable. It held basically where it needed to, around this like 25, 26 level, and has been bouncing some, but there's really not that much technical support there. You're kind of below the 2009 crash low. It's a very strange area that we're in. I do believe that the world needs more oil than we used back then. If you inflation adjust all this stuff, although there isn't really all that much inflation, as we know, at least not in commodity or stock terms. It's a little bit strange that we would have taken out that unless there was some type of a major shift happening. I don't know that we'll see all-time highs again in oil anytime soon. But I do think that at some point, I don't know that this is the exact low, but I do believe that these prices there will be higher prices at some point. There's been a lot of talk about this oil volatility index. It's been on a pretty solid tear lately, still making higher highs and higher lows, which is troubling. Although it did have a bit of a reversal bar the last couple of days. I think this is on the weekly. The weekly is pretty nasty. If we go on the daily, let's take a look, and of course the chart's taking forever to load. Yeah, you have a few days. You had a kind of an outside day 2 days ago, and then the last 2 days. Today you had a bit of a pop up. Of course, we had inventory numbers. There was some API numbers last night that were bullish, and the OVX is what I'm talking about now. There had been inventory numbers that were an unexpected draw, and then today there was a build, so those were a little bit conflicting. So yeah, it's probably oil is probably due for a bit of a bounce. You had contract roll last night, which I didn't realize, but we did. So oil is it's struggling around. I'm just looking on the continuous contract today. It looked above the 50 and then closed below. We'll have to see how that plays out in the next couple of days. You can use today's range, I guess, as a guide. So that's that. We know the jobs numbers as measured by the non-farm payrolls. I know that the media likes to drool over themselves over these numbers, that they think they're so great. They've all been basically misses. When they're not misses, they usually have revisions down later. Not very high quality jobs. There's a lot of issues with the quality of these jobs and, of course, the amount of pay. There hasn't been much of an increase in terms of what people are being paid in quite some time, and a lot of these are part-time jobs. Not to get too political, although I guess it's hard to avoid in this situation, a lot of this is because of Obamacare, in my opinion. Companies are part-timing people in order to save the tax of having to pay the health care. Just is what it is. GDP estimates were raised slightly by the Atlanta Fed, although they've been all over the board. They are still rather stall speed and crappy. ISMs have both service and manufacturing have been either at recessionary levels or near recessionary levels. The same for the PMI. although that's kind of 6 of one, half a dozen of the other with those readings. Durable goods, we know, had been kind of holding things up, but they've been weak lately. Auto stocks can't get out of their own way, and we know Boeing has had their problems. The dollar has also been a big problem, I believe, for the market last year. That was a big headwind. It's moderating a bit, although we are bouncing off the lows. There had been a down channel that it broke out of, and a few days ago we bounced off the down channel, and now we're basically holding around the 200 MA. You know, I've talked about this in UUP terms. That's the ETF, and I've drawn in some ranges. Anything below 24.47 has been unsustainable, and anything above 25.68 has been unsustainable, but it's been a little bit more stubbornly unsustainable up there, meaning it's sustained more up there than it has below. We did rally, like I said, off of the back of an old downtrend line, which is a little troubling. However, we are below the 200, and we are below a bit of a breakout level also around 25.23. So below there, it's still a little bit vulnerable, and we are starting to make lower lows and lower highs. So the dollar seems to be cooperating. I think that's been why you've had some of the rally in gold, and I think why you've had some of the bounces in oil. You know, these are all things that are priced in dollars. I can't unfortunately, I can't show the screen. Someone just asked. On Periscope, I can't. I do in my weekend review video. This one is sort of, if you type in the tickers, though, and you follow along, it's usually not so hard. I've often heard people say it's helpful if they play the rebroadcast of this while they're, you know, at another time when they can kind of pause and stop it. So the dollar, like I've said, is potentially the biggest problem I see for the for stocks or company corporate earnings, I should say, going forward. It's good, though, that it's retesting sort of a breakdown level here. I guess you could use the 200 MA here as your litmus test. If you're on the wrong side of the 200 MA, meaning above the 200 MA, there's issues. If you're below it, it's, I guess, better. The VIX. The VIX. So there's a mixed bag happening here. This last spike was a lower high than the previous, but we haven't taken out the low of the last swing, which was 19.5 yet. I would say if we got below there, we would likely see the channel low, which is currently in the 15s. We seem to be in a bit of an up channel. If you've watched my weekend review videos, I've drawn that in. The problem I'm seeing is that we have been making, up until this last spike, we've been making higher highs off higher lows, which gets very dangerous because that could be signaling a shift in volatility from benign to less benign or even very active, meaning that we may be going from a period transitioning from low volatility to more high volatility. That usually coincides with down or bear markets. You usually don't have a higher VIX in a bull market. So that's the VIX. Nuanced VIX, meaning moment to moment here. 22 is an important level where we did manage to close below there today, which is good. And we also closed a smidge below the 50 MA, which had been support on the last swing. The 200 MA comes in around 18 and 21. I will say this, though. It's good that a couple of things with regard to the market. It's good that the ES was able to hold the Fed day high. In ES terms, that was 1910. That's the 127 Fed day high. As long as you're above that high of day, I believe you can still be a BTD person, you know, by the dip. Below there, to me, gets iffy very fast. If that happens to also coincide with the VIX popping back up above 22 and sustaining, it gets still more iffy. And if it gets above 25 to 25.20, it is really shady to sketchy, meaning there's probably trouble. I've drawn in my previous videos, in the weekend review videos, a VIX key. I'll read that off to you guys now. If you're curious, though, it's in my weekend review video. 0 to 15 is low volatility, and that's purely directional options play, meaning long or short. If you want to play for a move, you don't want to be shorting premium, you want to be long premium in that instance. 16 to 17 I have as fair, meaning you kind of can play it either way. 18 to 19 is medium. You want to start selling premium when that's around into the level. 20 to 22 is elevated. 23 to 25 is the high end of range. So that means that if that's usually your healthy level of fear. Once you get into the 25 to 31 range, you have crash risk, meaning that you can have those down 1,400 S&P days. Ugly, ugly scenarios. And if you're above 31 in terms of the VIX, it's likely you're in the process of a crash, or at least a very severe down move. So that is my VIX key. Again, that is you can see that in my weekend review video, or if you want to replay this, just watch it on my YouTube channel. So that's the VIX. I covered the dollar. Something also that has been odd, if all things were equal, and I think we've all determined that at this point they aren't necessarily, you had the Fed raise interest rates, but interest rates cratered. Huh? Yeah. That to me tells that the market is trying to price in an economic slowdown and possibly recession. It is not healthy to have bond yields this low. It means there's no money demand. So why are bond yields this high? The Fed has indicated they want to raise rates, right? So my answer is this, is that the market now clearly doesn't believe that the Fed is going to raise rates any further. I think that the Fed made a big mistake. I think they felt they were backed into a corner. I don't believe they were in reality backed into a corner, but they chose poorly. And they have seen the consequences of that with a lot of market volatility. This whole QE thing has been to suppress market volatility and to reliquefy the financial system. So you haven't quite made a new all-time high here yet, but you did come quite close, and it has backed off a bit. The TLT is actually overbought. The stochastics are starting to point down, although today you had a pretty solid rally, a pretty decent engulfing day. We didn't even get a 20 MA touch. In general, as long as stocks or ETFs are above their 20 MA, they tend to be a little bit bullish, particularly when all the moving average are bending upward. The 20 is bending up, the 50 is bending up, the 100 is bending up, the 200 is even now started bending up. So I drew in you'll see this if you go back to the weekend review, I drew in an up channel, and we held basically, for the most part, the uptrend inside the up channel, if that makes sense. So when the world was ending in 2009, the crash high in bonds, meaning bond yield lows, you had a TLT at 123.15. The TLT is well above there here. And in the bigger picture, yes, lower interest rates are great for stock prices and PE multiples. The only caveat is when they get too low like this, it means recession, and junky earnings mean lower PE multiples. The earnings, it's funny. People always talk about a PE multiple. What should be the proper PE multiple of the market? And I think they make the mistake of taking the average line, which is usually around 15, and assume that that's an average PE multiple for the market. What tends to happen is you vacillate between extremes, meaning anything below 10 times earnings is unsustainable to the downside, and then anything above 20 times earnings starts to get unsustainable to the upside. In major blow-off top scenarios, you could see earnings up around 30%, or 30 PEs or what have you, but that's not really what we're doing here. I've stipulated in the past that the market deserves a higher than normal PE multiple because we've been at historically low interest rates, and with QE, it basically means that you should be trading at a higher PE multiple than normal because interest rates are lower than normal. Like a normalized rate is usually, 3.5 to 6%. I mean, usually markets tend to top at 6%. We are nowhere near there. So that to me would mean that there should be higher than normal PE multiples. The only problem is that growth is slowing and earnings are slowing at the same time. So that has probably been what's been propping the market up, so to speak. And if the Fed starts raising interest rates, that is going to get really fugly really fast. So just keep that in mind. The low interest rates are good, but they are signaling, in my view, that we are in potential recession. More to that, rates are also low because when the Europeans never really firmed their banking system or hardened their banking system like the United States did after the Great Depression. Yeah, we're going back to the 1930s and 40s. We introduced something that is known as FDIC insurance, Federally Insured Deposit. Federal Deposit Insurance Corporation is what it stands for, and it basically means if you put your money in the bank and the bank goes bust, you can get your money back from the government up to, I think it's $125,000 per account. Europe never did this. So very wealthy people who are in Europe need to put their money in safe instruments. 250. I'm sorry. They raised during the crisis. They raised it, so 250,000. But you have people who have millions and billions of dollars, and you can't just move that in and out of instruments rather easily without putting the price up or down on yourself. What is a deep market? What is liquid enough that you can buy in and out relatively easily, not suffer too much from price from your buying or selling? The answer is treasuries. They also are insured by the United States government. So when people get nervous, they don't worry about a return on their capital. They worry about a return of their capital, and they buy bonds. That's probably why the dollar has been strong. They sell their euros or they sell their renminbi, and they buy US dollars, and then they buy treasuries. So those two go hand in hand. That is the treasury market. We talked about oil. China has also been a wild card. Now, if you look at the FXI and you draw a Fibonacci retracement, I've done this in the weekend videos, we are below the 61.8, which should have came in around 32.15. However, there is a reference low around 28.61, and we blew through there just a smidgen. You know, a lot of people are perfectionists about levels. I often find the ranges are a little bit more helpful, but the point is that it basically held with a slight look below, and that goes back to 2011. So we snapped the trend. We're down pretty big. I mean, if you really want to get nuts, I mean, the all-time reference low I'm seeing is 1935. I don't know that we're going to get there or we won't. 78.6 is around 26.52. So it doesn't surprise me that this reference low and getting close to the 78.6 are holding things for a while. If China is not in crash mode, it's good for the markets. Even if they're down a little, it doesn't really matter. What matters is when it's in free fall. So I think we're in here for a period of slight bounce and a little bit of stabilization, which has been taking some pressure off the markets. There had been a lot of fear about the Chinese market reopening after Chinese New Year, and it really wound up not being that as big of a deal. So that's the deal with that. Big gauge, and something that has been really, really disturbing to me for a while has been the apparent meltdown in biotech, the IBB. I'll tell you, a lot of the stories here in these stocks, they're not considered expensive, like the Gileads and the Celgenes. These companies have tremendous earnings and tremendous patents. Here's the rub. A lot of funds own the IBB, and if they sell the IBB, it requires selling in those securities, so it becomes a self-fulfilling prophecy. You sell the IBB, they need to lighten up on their securities that make it up, the Gileads and the Celgenes. As those go down, they need to lighten up more on the IBB, and it's you know what I'm getting at. It's a step function. There's also problems that I believe with them having peak earnings. The leading presidential candidates, Hillary Clinton and Bernie Sanders on the Democratic side, and even Donald Trump on the Republican side, are talking about basically cutting the profits of these companies, negotiating better with the drug companies and getting better prices. I don't know if you are familiar, but if you go in other parts of the world, the price for these drugs are much, much lower than they are in the United States. And I think the feeling is that maybe these companies have reached peak earnings. Interestingly enough, we are in a pattern here, and if you look, sometimes it pays to take a look on the longer term chart. We're making lower highs and lower lows, and we took out the flash crash low, which was 284.16. Depending where you draw your Fibonacci's from, we took out the breakout, which was 275.40. There was a 61.8 roughly around there, around 281, and we held the 200 weekly MA around 240. So if you're long, I think you could use that as a stop. I do, however, think we may retrace to the 207 to 212 area. If you do a Fibonacci extension projected down, that's a 1.618. It's also the reference low from where the real blow-off move took place. I actually think that number can be overshot. I don't really want to talk about where I think it could go to, because I think people would be under your desks with your thumbs in your mouths, but in terror. But I do think that the IBB may have a peak in for a while, and these stocks are just kind of guilty by association and may have some regulation coming. They're a very easy whipping post. Banks are easy whipping posts for politicians, as are drug companies. These are industries that have a very hard time garnering a lot of sympathy from the public. Anyway, that covers the kind of the macro show part of this broadcast. But I think we could talk about some individual stocks here that people are interested in. I guess I'm just going to start out right away with the SPY, because that is the market and that's what really matters. Let's go on a 9. I usually tend to use 9-month dailies. It's less than a year and more than 6 months. It's usually a good. It looks good on the screen. So here's the skinny on the SPY. We had a reference low. We had a bunch of. Actually, I'm going to go a little bit further out. Let's do a 2-year daily. So on October 15th, we had a low of 181.92, and then from there we rallied and we kind of formed what looks like a big rounded top, and the flash crash low basically took you down to a double bottom. It stopped just shy of there. It was 182.40, but for all intents and purposes, it was a double bottom. After that, we had a rally and had a higher low, which came into place around 187.64. Then we rallied up quite high, but did not take out the old all-time high. So you had the topping process, the breakdown, the rally attempt, and a breakdown with a subsequent lower, slightly lower low. And now we've been in rally and chop mode. We have basically double bottoms again. Double bottoms are very powerful. We basically have double bottoms in the 181s. Let's just say 181.02 and 181.09, close enough for government work, and we've rallied up. We have yet to take out the swing high of the W, which would be 194.58. So the rally has to still be considered suspect. I do think there's been potential up to the 50 MA, which is currently in the 195 area. And I will say this, we have a Fed day range here. For those of you who have been following me for a while, I am like a Fed day range junkie. That stuff to me is just like, you can't get more Fed day ranges for me. In the SPY, the Fed day low of day was 187.06. And the high of day was 191.56. We have a lot of hammers there. We have a lot of attempted rallies there. Just take my word for it. Anything below 187.06 is bearish. Anything between 187.06 to 191.56, so between 187.06 to 191.56 is neutral. And anything above 191.56 plus, you can still be kind of long and playing by the dip. That is that's just how it is. When you're above a Fed day range, you're long. When you're below it, you're short. When you're in between, you should just be playing Minecraft or whatever the hell you're doing. That to me is what is interesting to me about the Fed day low is if you go to the pullback low from the flash crash, which was on 9/29, or wait, was this 9/20? No, it was 9/29. That low of day was 186.93. So this 187-ish area is really key. Below there is no good. If you lose that and things weaken up, and we take out the 181, I believe in no uncertain terms that the market will be in free fall. And round she goes, and where she stops, maybe we know it could be 173.71, which is another reference low. It's also, at this point, it's below the bull market primary trend. But 170, if it happened tomorrow, I don't expect it to, it would be around 175.20, this looks like. Let's just say 175. So that area could be, I don't believe that would stop there at that point. I think that it's too close to the 181. I think it could be a pause point, but I don't know that we would stop there. That, by the way, that trend is if you connect the 2009 crash low to the 2011 bear market low, and you just let it rip, let it run. That's the primary. That's a big trend line. If that snaps, you're gonna hear a lot about it on TV, and you'll be very nervous. But you won't really have to worry about it because you won't really want to be long if we break 181. You'll want to be short. So that's the way I see it. It's a little surprising to me that we haven't really broken down already, that we were able to have that double bottom low, but sometimes a market needs to rally before it can sell off. I think there's still a lot of hope and belief out there, and I wouldn't say that I'm, all right, so I wouldn't say that I'm really bullish or bearish. I'm sort of just tactical here. Although if I had to say if I was one or the other, I would say more bearish, honestly. I honestly am more bearish. I'm very cautious, and that's for a few reasons. One is because we are below a lot of distribution up high. There's a lot of past price action with people who have bad trade location, who are waiting to be made whole and praying for the market to come back. The real significant breakdowns I saw the market have were below 204.12 and below 197.86. If you were to do a 61, let's say a 50% fib, that would be one from the lower high peak, which was 211.66, to the 181.02 low. We're basically at the 38.2 right here. The 50% would be 196.34. The 61.8, which is really interesting to me, is 199.96. We know 200 is a big strike. We know that we had prior tweezer lows there, and when they broke, the market it tried to catch some traction, but in the end, it was over the cliff. So if there were to be a rally back up into that area, like that 200 to 202 area, you want to lay into that heavy for right or right out short, in my opinion. You could sell out of the money calls. You can just do SPY. I think that's a good right or right out area for a good trade location. We might not get that high. Like I said, my first target is descending here, which was the 50 MA. We might see that. There'll probably be some mechanical trade there as a right or right out short. And we've also just rallied a lot off the low. I think today, really, I don't see today as really being so bearish. I see it as just a pause consolidation day. I said that in my my morning video. I do these morning videos on Instagram. I'm getting better and better at them. Today's was done on the first take. It's really hard to cram stuff into 15 seconds. You'd be surprised. Or maybe you wouldn't be surprised. But the 15-second videos I discussed today, I thought today would be a consolidation day. If you're not following me on there, by the way, it's Justin Pulitzer Trades on Instagram. Those videos are, I think they're pretty good, and I usually put a little bit more extensive commentary under there. Usually I'll elaborate a little bit. That's sort of, I call it JP Market Movers, and if you want to look that up by the hashtag, please do. So those are the levels that I see as key. We held, like I said, above the Fed day high today, and the VIX held below 22. So I would say that today was a little bit more encouraging than bearish, although there was a lot of weakness today across the board in stocks. You had a rally early in oil, and when that reversed, of course, we are linked to oil, and when oil goes up, the market goes up, and when oil goes down, the market goes down. It's not like it was in the 90s or even the 80s and 90s. Most of the market these days are algorithmic trading, so people punch in, their fund, what they want to do based on certain keys. I've noticed at market extremes, at the highs, oil was a problem, meaning as oil went higher, the market went lower, and now at the bottom, as oil goes higher, the market goes higher. So it's flipped. Usually, like I said, that happens at oil extremes, so it, to me, is telling. Everyone's really aware of the oil story. There's going to be, I believe, if there aren't already, a lot of bankruptcies, and I think that's been weighing, what's been also weighing on the high-yield bond market, but I don't want to get too much into that now. I want to actually try to wrap up shortly. So let's just fly through a couple of these stocks you guys wanted to talk about quickly. We just went through SPY, Facebook. So I'm going to take these in, I'll just take them in, all right, let's just do them in the direct order. So we'll start with Facebook. All right, so I've been really a Facebook bull for a while. I'm a little bit cautious here. I'm long-term bullish, short-term cautious. I think it's going to chop around for a while. It's doing exactly what it always does. It runs into earnings. It ran a little bit extra this time, and now it pulls back and chops sideways, usually freaks everyone out with a break lower and then rallies back up to new highs. I've drawn in a progression line. I've said anytime we're on the upper side of that, it's a sell. That's met a lot of resistance, and then people are always sorry they didn't. Right now we're hovering above the 50 MA, so if you want to use a stop, use the 50 MA. If you want to give it a little bit more room, you could use yesterday's body low. It sounds kind of perverted, actually. I should come up with a better term, but body low is 101. Let's see. There's 100 MA right there too, so it's, let's just say 101.90 to 101.85-ish. I like the 90 level, the 101.90. If you get below there, you might want a GTFO, or if you want to try a short trade. The IV isn't high enough in there to sell puts yet. You want to wait for a down move if you want to do put ratios. I often like to do that to play long. So right now I'm fine with being long over the 50 MA. If you get stopped out below there, just the levels are the levels, man. Just is what it is. Someone asked me about Deere. This isn't a stock I really cover very often. I don't like that it's rallying ahead of the earnings, which are on 219. I love when stocks sell off into their earnings. It's possible they continue to rally. Like, look what Priceline did. I was really very frustrated by Priceline. I've been talking about playing it long. It had like a $50 move the day before. It's very hard to chase stocks. The risk reward, I still thought the stock was going higher, but I was a little bit worried about that. Deere, it looks like it's trying to break here. It's been making some higher lows and higher highs. If you want to play it if there's some type of a pullback, you could play against the 75.18 stop. That was like the last major swing low off the 20 MA. It looks like the 20 MA is held body-wide. All right, so here we go. That looks like we're a little bit overbought on the stochastics, but the 20 MA with looks below, have held. If you get a close below the 20 MA, and listen to this, the 20 MA, the 50 MA, and the 100 MA have a lot of confluence down in the 76s. So if you want to buy it, if it pulls back, that's your area. Right or right out against those major moving averages. Below there, it is GTFO City. For those of you who are new to me and don't know what GTFO means, it means get the F out. And when I say F, I mean F. So that to me is the level. It also coincides with the recent uptrend. I like put ratios with that area in mind. So that's Deere. They tend to not do well on their earnings reports. They tend to be very misanthropic, so I'd be a little cautious. All right, I'll cover LinkedIn in a minute. Let's do LinkedIn now, actually, because we did Facebook earlier, and it's fresh in my mind. So I had discussed in the weekend review that LinkedIn was getting close to a channel low and a reference low around 94.75. We didn't quite get there. We're rallying. It looks to me like they're going to want to rally it a little bit further. The damage done in this stock was really immense. Believe it or not, it wouldn't surprise me if longer term the stock went significantly lower, but I think its destiny is likely going to be higher before lower. So I think if you want to play long, you could define your risk, maybe buy some upside call spreads, but and just trail up your stops. I would be a little bit iffy, It's unfortunately here, if you're first asking about it, it's run a lot. It's at 113. You'd really want to stop out below 98. I mean, that's a lot of bucks, but I could give you an easier level. If you want to play it, you don't really want to see this thing go back below, I would say 10. Hold on a minute, 108. Really, I usually like to use the earnings gap bar. Above it, I like to be long, and below it, I like to be short. You're kind of in it right now, so there's really not that much to discuss. But I do think that we are going to at least test into the gap, so I think short term, it's probably going to go a little bit higher. I know a lot of people are going to play this for the gap fill right away. I don't know if you necessarily want to be the first people buying it. Like, what I would love to see it do is look into the gap, pull back a bit, chop, and then run and go for the gap fill. It would be like sort of a second mouse gets the cheese gap fill. That's what I think. Yeah, there you go. Second mouse. So that's what I'm thinking with regard to LinkedIn. And I could be wrong. It could just fill, but I'll probably be right. So that's LinkedIn. We covered Deere. Apple. Ay. My God. My apple of my eye, right? So Apple has been in the news a lot lately. I think that they are going to be villainized by the government, and I do think that eventually they're going to have to give access to the iPhone. I don't know how that's going to do with their sales overseas or sales here. I mean, I'll still buy iPhones. I mean, here we go. The platform is crashing on me. We may have to, if this doesn't come up, we may have to cut short. That would really, really suck. So the platform is crashing on me. This has been a problem all day today. Anyway, I know Apple's chart well enough that I can speak about it. If this doesn't come up by the end of Apple, we're unfortunately going to have to end here because I don't have chart access. All right, so Apple, I do believe Apple at some point is going to fill the gap back up to 100. However, I don't know that if it's going to be the move to 100 and then lower, or if we're going to go lower first. I'm seeing that 92 was an important area. That was the flash crash low. If you are long Apple, be so against 92. If you are looking to short Apple, I think below 92 would be fantastic. Either back at 100 for right or right out, or a break below 92. And a break below 92 to me would get you 85s. If 85s don't hold, you could see 75s. I know that sounds like a lot, and these things tend to happen. What I think people don't understand is that stocks tend to move to extremes, not necessarily out of logic or rationality. It's out of necessity. All the people who were wrong, or all the people, you have a lot of people who are short when stocks are going up, and when you're going down, you have a lot of people who are still long, playing hope and pray. I think it's all right to be Apple long against Apple here if you want against 92, but I will say that the stock is looking a little weak. I would prefer to play, if you want to get long, wait for it to come down, let it get ugly, and then sell some out of the money puts when the IV gets jacked into like the high 30s to mid 40s. Like if you could get IV into the 42 area, it's good. When Apple IV is around like 25, 6, 8, it's not attractive enough. Like I was looking at the puts today to do put ratios. Often I like to call that that's sort of my way into a stock. Often what I'll do is I'll buy a high strike put, and then sell 2 strikes lower out of the money, so I get some of the down move and then get in cheaper. So it's sort of like getting paid to get in. The problem you face is if the stock really guns down and it blows through the lower strike. That's why I always say to do that on shorter time frames. All right, so unfortunately, it looks like the platform is down. It's been giving me problems all day, so we're going to have to wrap there. I'll cover more of this. I'm going to keep a list of these ones. The IBM, someone asked about Silver, Walmart, Priceline, Win. I'll cover them all in the weekend review. Win I could speak about intelligently because I was looking at that chart today, so actually we'll end on Win. Win got up to the 200-day moving average today. I do think that there is room into the mid-80s potentially, but I don't like the risk-reward first chasing it here. I would like a pullback a little bit lower, maybe, like if you get like 5 or 8 or $10 low. I mean, the stock ran $30 off the lows. If you can get a little bit of that back, I would be interested in either selling puts. Like if you can get it in the mid-60s, that to me would be a little bit more attractive. I'll cover that one in more detail in the weekend review, though. So that's my story. I'm sticking to it. I hope you guys enjoyed this. I'm sorry we couldn't go further. I was here and wanted to, but my effing charts aren't, they're not working. It's been a platform problem all day. Anyhow, thanks, guys. If you want to see this again on rebroadcast, you missed some of it, Justin Pulitzer Trades. And I'll see you guys in the weekend review, which should be up on Sunday. Cheers.